Welcome to Daily Digests for July 22, 2026. U.S. stock markets saw a sharp post-market earnings split today as Alphabet delivered a blowout second quarter, while Tesla missed profit expectations. Alphabet reported EPS of $9.11, far above consensus estimates, driven by an 82% surge in cloud revenue, while raising full-year CapEx guidance to $200 billion. Meanwhile, Tesla reported Q2 EPS of 33 cents against 51 cents expected, as heavy capital spending pushed free cash flow into negative territory. The contrast between big tech earnings highlights how capital allocation is driving stock performance. Alphabet's quarterly revenue reached $119.8 billion, with Google Cloud expanding to $24.8 billion in quarterly revenue and operating margins reaching 34%. In contrast, Tesla faced margin compression from battery and AI infrastructure outlays, leading to a $1.1 billion negative cash flow quarter, despite $28.2 billion in top-line revenue.
Alphabet's updated capital expenditure plan brings full-year 2026 investment to between $195 billion and $205 billion. While management warned that free cash flow will remain under pressure as data center and custom silicon investments scale up, the 82% acceleration in cloud revenue demonstrates that enterprise AI demand is converting into top-line growth.
In hardware infrastructure, Supermicro Computer provided a major positive surprise by guiding fourth-quarter gross margins to 15% to 17%, up sharply from prior 8.2% to 8.4% projections. Fueled by over $60 billion in pending server deliveries and a favorable product mix, SMCI shares surged in after-hours trading, easing fears of price wars in AI rack deployment. In semi-technology, AMD secured a significant agreement with Anthropic to supply 2 gigawatts of MI450 accelerators starting in early 2027. The deal confirms that major AI labs are actively diversifying their hardware supply chains beyond NVIDIA to lock in compute capacity for next-generation model training. Beyond headline tech earnings, broader U.S. market internals remain healthier than the S&P 500's modest pullback suggests. Roughly 66% of stocks in the Russell 3000 index are positive for the year, with a median return of 12.6%. Weight semiconductor names and select megacaps rather than systemic weakness. Retail investor activity continues to provide a strong floor for U.S. equities. Retail cash equity accounts have logged 0 net selling days throughout July 2026, marking the strongest July for retail net buying since 2020. Individual investors are actively buying dips across broad market names, even as short-term tech volatility rises. The market is undergoing a sharp separation between resilient index components and legacy single-name drawdowns. Nike stock has declined 75% from its record highs, trading near 2014 levels as consumer shifting and margin erosion hit traditional brand moats. This underscores the market's aggressive repricing of companies lacking pricing power or tech tailwinds. In regulatory developments, sovereign risk in the AI stack reached a new milestone. The Department of Defense formally designated Anthropic as a national supply chain risk, marking the first time a domestic software entity has received such a designation. The move creates immediate compliance and procurement ripples across defense tech partners like Palantir. The Pentagon's action reflects a broader trend of federal involvement in critical technology supply chains. Over the past year, the U.S. government has taken equity stakes and warrants across key domestic suppliers, including IBM, Intel, and MP Materials, shifting from traditional oversight toward direct strategic participation. In international defense, Poland has emerged as NATO's top defense spender, allocating 4.8% of GDP to hard defense, with potential to reach 7%, including dual-use infrastructure. Poland has placed over $65 billion in contracts with U.S. defense manufacturers, providing structural order visibility for prime contractors like Lockheed Martin. In fixed income, long-term borrowing costs remain elevated. The 30-year U.S. Treasury yield has spent 27 days above 5% this year, a frequency not seen since 2007. Persistent high yields continue to raise the discount rate for long-duration growth assets and increase interest expense burdens across corporate credit. To recap today's digest for July 22, 2026, Track how markets digest Alphabet's $200 billion CapEx guidance versus Tesla's cash flow miss. Watch SMCI's margin recovery levels in regular trading, and monitor 30-year Treasury yields for broader equity valuation impact. Thank you for tuning in, and we will see you tomorrow.